The poor economic data coming out of Europe has given the dollar something of a boost against the pound and the euro. But after such a long time in decline, can the dollar's mini rally last? For some insight, joining us now is Keith Miller, currency strategist at Corporate FX. Keith, thank you very much for being with us. So
Good morning.
22-month low for the pound against, it's just, how long can it last?
It is a 22-month low, and what's really driving it is a little bit of dollar strength, as we've seen over recent weeks. But more importantly, we're seeing extreme sterling weakness. Now, the Bank of England inflation report earlier this week really pushed this forward. Mervyn King very clearly indicated that we are expecting UK inflation to peak at or above 5%. That is way over their target rate. As a result, sterling lost an awful lot of support, and that coupled with the dollar weakness that we've seen recently due to what is predominantly their okay position on GDP, extremely high inflation, and they've almost got the reverse of what we're seeing in the UK, and the light is almost bright at the end of the tunnel for them, and they can look to tighten their policy.
How are they able to come out of this a little bit better than Europe?
It's ironic, isn't it? It all started over there, and they're the people that come out. It's not much fun, is it? They reacted extremely quickly. The Fed, almost immediately, they started to cut their interest rates at the start of the credit crunch. They also offered a lifeline for a number of their financial institutions. They reacted, as the Americans do, extremely quickly. And as a result, they're further through this economic cycle. Europe and the UK, they were slightly slower in their reaction. Europe's were, or the Eurozone were inert, if you like, a little bit, and their reaction and their hit from the credit crunch was delayed.
And it seems as though that's said about the U.S. dollar, but inflation, though, is at a 17-year high, not since the Gulf War in 1991. What can the Fed do about that, if anything, or if they are going to do anything?
They can do something about it, and again it comes back to growth. They're in a rather unique global position in as much that their growth, although it's not particularly good, it's not as bad as the rest of it, and they are in a position where they can look to tighten their policy and increase their interest rates if they need to, directly combating that inflation. We've got to remember that high inflation, 5.6%, it is a 17-year high, but a lot of it is energy costs. Now, the decrease in oil prices recently have definitely taken the pressure off of that, and what we'll see, once that decrease in oil price filters through to the real economy, we can expect to see a lower inflationary figure, not only in the US, but also across the globe.
Yeah, the problem is that when you're relying on the fluctuating price of the energy and oil, it may not be a good thing.
It's a rocky road.
Yeah. Thank you very much.
Thank you very much.